All right, guys, welcome back to another episode. Today we'll talk about the market and how I think it's going to go down really bad on Wednesday for different reasons. I think the first reason is the CPI. As we can see here, the CPI went down, actually rose in December to um, 2.9%. So it's higher than November. You can see here that's the unadjusted 12 months ended. See December. So, um, so the Fed last month, I think back last meeting, back back in December 18, they forecast two rate cuts. And then after the meeting, NASDAQ went down 4%. So, and it was from December 17th, it was December 18 after, I think, 3 p.m. 3 p.m., it went down from 5, from 5:36 to 5:15. So, it was definitely a very good opportunity because the payout was like between 150 to 200 times the money. So as you can see here, we didn't see any big drop from December 18 until January 26, like let's say, you know. So I think on January 29, we have two scenarios. One is probably they get out the Fed, they rely on the CPI as an indicator to make a decision. So I think probably they either get a forecast one rate cut, okay, and then they will cut this on next meeting. They'll cut the interest rate. That would be it for the until for the rest of the year. And if that happens, the market will go down. I mean, really down, probably like 4%. Because the 10-year treasury, if we look at the 10-year treasury, it's going up and up. So it's right now at 4.6. And a lot of people said that it might go to 5% or even 5.5. I even watched a video for BlackRock CEO talking about how the 10-year treasury might go up to 5.5 and how that will impact the equity market, obviously going down. And so, and so I think I think it's a good opportunity to buy puts, and it all varies. Um, when the market opens on January 29 on Wednesday, and if Triple Q, the price movement was flat, or let's just say went up like 1% or something like that, we didn't see any volatility, whether going up or going down. And then we watched the the Fed meeting, and then we gotta like pay attention to what Mr. Powell, what he's saying about the interest rates. And then if it was a negative, or bearish, if it was a bearish, I think it would be a good opportunity to buy 0 days puts around 3 o'clock because the price of the contracts would be so cheap, and it would be the best opportunity to buy them maybe at $2, each contract, and then wait, until triple Q drops. If it drops 4%, then you can make I think 200 times your money. So this is my prediction for Nasdaq on Wednesday. Also for Meta, I'm very bullish on Meta. The reason why, because of two things. One is the AI spending that they're gonna do in 2025. They said that Meta to increase spending to $65 billion this year in AI, and and also they're working to they're building an AI engineer to help with coding tasks at Meta. So I think yeah, especially that last, we definitely have to look at the revenue. I think the revenue would be the key indicator for the stock to go up. So as you can see here, Meta, from an experience, this stock reacts to revenue, not earnings per share. So I think yeah. So I think if it beats the forecast for this quarter, I think the stock is gonna go up probably by 15%, and definitely it would be a good opportunity to buy calls. And then Tesla, I'm bearish on Tesla because the reason why I think the expectations are too high on Tesla for this quarter, and so if they don't perform really well, if they don't beat the earnings very like higher than 20%, then it's gonna tank because it did not satisfy Wall Street expectations. So this is a very important thing that I noticed. So unless they do, which is really hard. The thing is, like, if you look at the reports, the delivery report for Tesla for quarter four 2024, you see here the deliveries are way higher than production, which means we sold a lot of vehicles more than we produced. So the revenue is going to be way higher than the previous quarter. However, this stock, Tesla stock, does not react to the revenue, so it reacts to the earnings per share. That's where I've noticed, analyzing that stock, that it reacts to the earnings per share. And so the earnings per share last quarter was like it beat the estimate by 20%. So for this one, since the forecast is higher for quarter four than quarter three, so we have to be around, I think, let's do the calculation. So 77 cents per share. Let's say 25 or 22%, 25%. So that's 19 plus. So we gotta be almost 96 cents per dollar, the earnings per share. And that would definitely drive the stock up. Um, I would say 16 or 18%. So if you buy out of the money call option, you will definitely make 30 or even 40 times your money. So, but if it beats the estimate but less than 20%, so that means let's say 18%. So that's 13 cents. 7. So 90. Um, it would be a scenario where yes and no, because the forecast, like, the thing is, some stocks, if the forecast is higher than the previous quarter forecast, and it beat the estimate, the stock will go up because Wall Street is still bullish on the stock. But if not, it might tank. So you can play it either way because Tesla is a very high volatility stock, so it doesn't matter. So if if you play it call and put at the same time, you still I think can make money as long as the stock tanks really hard or goes up really high. So, but my analysis, I think it's bearish for Tesla, bullish for Meta, and bearish for Nasdaq on Wednesday, January 29th. Thank you guys for watching, and see you in another episode.